The Federal Reserve is planning on scaling back the purchasing of mortgage-backed securities. Hi guys, I'm Rod Moser with NextHome Navigator, your resource for all of the relevant information you need to be able to win in the real estate market today. I want to discuss today an article that came out in the Wall Street Journal that talks about the Federal Reserve scaling back the purchasing of mortgage-backed securities. Why this is important information for you to know and how it could impact you moving forward. Okay, so let me share my screen really quick, you guys, and I'll just kind of go through this article. Right here, it talks about the Fed cut its short-term benchmark interest rates to near zero in March to help stimulate the economy during the pandemic. And they started buying $80 billion in treasuries and $40 billion in mortgage-backed securities every single month. What we're going to focus on are the $40 billion in mortgage-backed security purchases. Okay, so to kind of make this easy to understand, when the Federal Reserve buys mortgage-backed securities, it frees up money for lenders to turn around and lend that back to people that are buying homes. So it stimulates the economy and helps stabilize interest rates, which was the reason that they did that. The housing sector has a huge impact on our nation's economy and really on the world economy. And so it's always in the Federal Reserve's best interest to try and help keep the housing market strong. They started to put a lot of money into mortgage-backed securities. Well, starting in November, they're going to start cutting back by $5 billion a month, it appears, the amount of money that they're putting into mortgage-backed securities until that gets to zero. Well, interestingly enough, when this news hit yesterday, the reaction was that interest rates started to go up fairly quickly. So let's talk about bonds and yields. So one of the reasons that the Federal Reserve is deciding to cut back the purchasing of the mortgage-backed securities is because they feel like there's enough private investors out there that will fill the void. So there's really no reason for the Federal Reserve to buy mortgage-backed securities. Well, the yield on mortgage-backed securities is really small right now. It's not very appealing for a lot of investors. But investors are buying a lot of corporate bonds. They're a little higher risk and they're getting a little higher yield, and there's plenty of money flowing into the corporate bonds. So they feel like if they can increase the yields on the mortgage-backed security bonds, that there should be enough interest and enough private money out there for people to fill the void of the Federal Reserve. Let's talk about that really quickly. Increasing the yield. There's two ways to do that with mortgage-backed securities. One option is to improve the security itself, right? By tightening lending standards and reducing the amount of bad debt that's out there, that can make a stronger or a better yield. So that's one option. You could see and will likely see a tightening of lending standards moving forward. Option number two is actually to increase the rates so that the yield spread is bigger for the investors, so they can offer the investors a larger yield in buying mortgage-backed securities. Well, what's that going to do? Yeah, it's going to make housing costs go up just a little bit, which can have a softening impact on the housing market. Every time interest rates go up by 0.5%, it impacts the purchase power by 6%. So for example, if today you could secure a mortgage at 3.5% and buy a $400,000 home, if rates went from 3.5% to 4% for the buyer, the same payment for the same 30 years would now buy them about $24,000 less of a home. So the same payment would buy them a $376,000 home as opposed to a $400,000 home. So as interest rates increase, it can impact the amount of home that somebody's able to buy or to qualify for, which can lead to a decrease in value. It'll be interesting to watch this as we move forward to see if there really is enough private lenders out there to fill the void of the $40 billion that the Federal Reserve has been putting in. It's going to be eased gradually until it gets to zero. So I think they'll be able to monitor that and keep an eye on it. But for the immediate future, guys, I would expect rates to start to increase and lending standards to get tighter. If you happen to be one of those buyers that got frustrated with the housing market over the last 6 months. You were out looking for homes, put multiple offers in on multiple different properties and didn't win them because they were all, people with a lot of cash that were offering above appraised value. Guys, I have good news for you. We've nearly tripled the number of available active properties on the real estate market in Salt Lake County since June 1st. That's right, tripled. We went from just about 400 active homes on the market. Yesterday, we had 1,200 homes on the market in Salt Lake County available for sale. Yes, we still have a light inventory, but it's gotten better. And you're not likely to be in a multiple offer situation anymore. In most cases, it's taking 2 to 3 weeks to get a property under contract as opposed to 2 to 3 hours. And instead of multiple offers, you may only see one offer. The likelihood of you having to pay cash over appraised value is diminished greatly because the inventory levels are starting to go up. And now with the new news about the interest rates, guys, time is of the essence. I would encourage you to get off the fence. Contact us when you're ready to navigate to your next home. Make sure that you're talking with an expert that can help you navigate the future and make sure that you can secure the best financing possible. Guys, look forward to hearing from you. If you have any questions, if I didn't address something, please comment below and make sure you hit that subscribe button so that you don't miss any other information that might be important as you're moving forward. We look forward to hearing from you.